Hi, and welcome to the What Are the Forex Market video. What you will learn: how much the foreign exchange markets are worth, why we trade in pairs, the technical aspect of foreign exchange trading, and the fundamental aspect of foreign exchange trading, both very crucial to your trading career. The FX, Forex, or foreign exchange markets are the most liquid in the world. It is estimated on average between 4 to 5 US dollar trillion are traded every single day. When referring to the currency markets, the general market term is FX. It can be referred to as Forex and foreign exchange, but essentially it is all the same thing. It is important to learn the language and terminology in trading. Market commentators and analysts always use the correct trading terminology, so you don't want to miss important information. We can all understand the basic concept of currency. A country will issue its own currency in order to allow people to buy and sell goods and services. The perceived strength of a country's economy is usually reflected in its currency rate. So a country with a strong currency, in economic terms, is seen to be economically sound. When you put the term trading with currency, however, things can get a lot more complicated. It doesn't have to be, but the markets and its terminology are designed to be intimidating and stop ordinary people from being involved. By the end of the presentation, you should see that it is not as complex, but the expert would like you to believe it is. Why Forex then? Let's take a closer look at what makes up this market and why it is so fascinating for novice and professional traders alike. This is a 24-hour market where you can actually trade 6 days and have excess liquidity in the markets. That is seldom the case where you would not find a buyer or a seller for your position. It is a market that you can easily go long or short, and we can explain these notions later on. They're easy to understand, unlike options and futures or stock market, where stock splits and reversals apply. There are no commissions, or there most often are tight spreads. You also have the notion of leverage. This term, sometimes also called gearing, simply means that you're putting up a small amount of capital but allowing you to trade for a much bigger position. How big the position is will depend on how big the leverage is. You only put up a fraction of your total initial capital exactly because of the leverage we discussed above. The FX market is an over-the-counter and OTC market. The counterparty to your trading is the provider of the service. Spot Forex is traded in specific amounts called lots. Long is a terminology used to determine that we are actually buying the pair. Short simply means that we are selling something which we have not previously bought. We can trade successfully either buying or selling an exchange rate. Selling short an exchange rate means that we simply make money when it falls. Remember, your target is to be profitable, not to prove that you're right. FX is not about holding the currency in its physical form. Whether you buy or sell a currency just depends on your view of the market. When buying, the exchange rate tells you how much you have to pay in units of the quote currency. The most common or well-known currency in the world is the US dollar. You can argue this any way you like, but with commodities like oil and gold priced in dollars and the most countries' reserve of choice being the US dollar, it is hard to argue against this. There is estimated to be $1.39 trillion in circulation by the Fed, the Federal Reserve. In trading terms, the dollar is king. Most of the major currency pairs that traders, banks, and institutions favor are those including the dollar. It is, after all, the biggest consuming nation on earth and is more often than not seen as a safe haven in times of turbulence in the markets. Let's take a look then at why currencies always trade in pairs. When you trade in the FX markets, you can't simply buy or sell a particular currency. You need another currency to trade against. If you want to buy the US dollar, then you have to trade this against another currency. In the example of the euro against the dollar, if you want to buy the dollar, then you are selling the euro and therefore buying the dollar. It may seem complicated, but let's explain more about how currency pairs are created. When the currency pair is created, a decision is made as to which is the strongest currency. In the example of the euro-dollar, the euro was seen to be stronger than the dollar and therefore goes first. If you trade this pair, then you will be simultaneously be buying or selling the base and therefore doing the opposite the quote currency. In this example, the base is seen to be the euro while the quote currency is the American dollar. By trading currencies against each other, you are exchanging one currency for another. Traders can find value therefore in many different ways. You do not always have to trade the euro against the dollar. You can trade the euro against the yen or the British pound. This way, you can take advantage of all the factors that make currency markets move. In this example, if the euro-dollar is quoted at 1.5, this means it takes $1.5 to buy 1 euro. Remember, your decision to buy and sell is based on the base, first, of the currency pair. So if you're bullish the euro, then you buy this pair. You're buying the euro at 1.5 and selling simultaneously the dollar without that meaning that two transactions are taking place. It is just one which entails two legs. The value of a pip and what is the effect of the leverage. Let's take a look then at this important notion. A pip is simply a unit which represents the smallest amount by which a currency pair can move to one direction or the other. In this example, we use the euro against the dollar at 1.1210. A position of $100,000, often called one lot, would be multiplied by 0.0001, that is 4 decimals, and that would equal to $10. A 1 pip movement in the exchange rate will mean a $10 loss or gain for you, depending on whether you have gone long or short. Important to note at this point is that although the position is a $100,000 position, you as a trader are not called to deposit that amount of money. In fact, due to the leverage effect we discussed above, you will only be required to deposit a small fraction of this amount. How much would that be? Let's take a look at the table below. Leverage is usually up to 100 times. The table shows typical leverage levels expressed in ratio and in percentage. If we take the example of 100 to 1 leverage, this effectively means that for every $100 worth of position, we only deposit $1. This is the power of leverage, which can both be seen as a cushion but also as a sword. It is magnifying your gains but can also result in bigger losses. Which is exactly why a proper risk management should be in place, something that we will go through in one of our next videos. So stay tuned on this one for now. Now, when trading FX, you have to understand traders' perception of value. This is where you have to balance up the technical and fundamental sides of trading. This is on average about 80 to 20% respectively. Combining these two approaches will help you get an edge in this very competitive marketplace. Technical trading is all about charts. All the candlestick charts, patterns, indicators and oscillators that go into technical trading. Fundamental trading, on the other side, includes figures like gross domestic product, the GDP, the non-farm payroll, or the interest rates decision. These will all determine how people view the dollar's value in the short, medium, and long term. These will be covered in their own presentation. For the time being, we will shortly focus on the technical side of things, bearing in mind that the self-fulfilling prophecy is in place when trading technicals. Many people will recognize the same technical levels and setups, and so information provided becomes less relevant unless combined with other aspects of trading. Now let's take a look at our euro against the dollar graph. Technical trading is important when looking at the FX markets, as this accounts for around 80% of trading calls. All over the world, retail traders, banks, and institutions are looking at charts to make trade calls. You should have your own technical strategy when trading the FX markets. We have plotted here a certain move of euro against the dollar, where you can clearly see that this is a series of what we call candlesticks, effectively candles which give us all the information we need, i.e. the high, low, open and close of that time frame. We will cover these in more detail in another presentation. For now, we will focus on the fact that the euro is above an important technical level and thus seemingly able to make a new high before it makes a new low. Charts like these are what traders plot and use every day, and so you will. They are a form of providing a powerful message with a snapshot of the market and the product in question, giving you several tools of analysis. Knowing the technical view of the market allows you to assess whether you are buying into strength or selling into weakness. As discussed, there is the other 20% that explains market moves, right? And this is the fundamental trading aspect depicted in any new news, key data releases, speakers, or global events. Data for the USA will be very influential on the US dollar. Also, most other markets. In the table here, we provide some of the key announcements that are made around the non-farm payrolls, the unemployment rate, and so on and so forth. It will all try to answer the question of whether the US dollar, in this case, will be more in demand or less after the figure. By understanding when this data is released via an economic calendar, you can trade with a 20% potential shift of this fundamental sentiment. It is another way to structure your trading day, week, or month to know when key market moving data may hit the products you like or hit the products you trade. There are nearly 200 currency pairs that are traded on the global markets, not only the most popular ones such as the euro dollar or the cable, that is, the sterling against the US dollar, but also the dollar yen, the Australian dollar against the Canadian dollar, or the euro against the Swiss franc, and the list goes on. There are certain things to be aware of when choosing the currency that you trade. The first one should be that more obscure currencies like the sterling against the Norwegian krona will incur wider spreads and be more expensive to trade. The big banks and institutions trade currencies in baskets, so more than one pair simultaneously. Beware of currency correlations and coefficients. In short, a correlation is a term used to denote or explain the relationship between one currency with another. In other words, what are we expecting from one currency to do when another currency moves up or down? It is a very important notion to keep hold of. The main news and data, however, will generally affect the US dollar, the British pound, and euro. So as a beginner, these currency pairs are the best ones to start with. Summing up, we have seen that by far the foreign exchange markets are the most liquid, with an estimated 4 to 5 trillion US dollars traded every single day. For new traders, such as yourself, this is a good place to start your trading experience, as you can easily get in and out of trades. Also, with the amount of news out of the USA, from possible recession to higher interest rates, there are lots of things happening to keep the markets moving. Choosing the risk based on the country's GDP in global comparison is a good place to start. The ability to hedge and trade currencies against each other is also a prospect a lot of traders like. This way, you can pick markets that inversely correlate and trade two markets at once while making the most of your deposited money, therefore capital. In short, hedging stands for protection, and therefore traders tend to take opposite positions to protect themselves from sudden swings that will deteriorate their positions, bearing in mind that this might also mean giving up some of their original projected gains. All in all, FX sounds complicated, but essentially this is trading one country's prospects against another's. Stick with us and enjoy the ride.